This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Wednesday morning. I'm Prashant. With me, my colleagues Rima and Surabhi. Guys, hi. Good morning.
Hi, good morning. The Santa Claus rally continues. Santa in the house.
Santa in the house. I decided to wear red. The market doesn't know this color anymore. So for good measure and good luck and the color of the season, I said, let's go with red. Otherwise, there's just one color. Green is the color of this holiday season,
Absolutely.
I think.
And it's been, and by the way, overnight as well, US has done very well. So, it's a good place to pick up from. I'm not going to start where we left off yesterday because, yesterday we added another 100 points after coming out of a 3-day weekend. And this morning we're waking up to S&P 500, which is now almost at a new all-time high. The last high was made in January of 2022, and as of yesterday's close, we basically are about 0.5% away. The gain overnight was 0.5%. The Nasdaq actually did even better. There's no news flow or anything of that sort. Volumes were a little thin, but compared to say the 3-month or the 6-month average, etc., that's to be expected. But markets moved up. That's the more important point. I looked at yields, no real change, under 4%. You look at the dollar, it's come off a little bit, but again, nothing dramatic. So I'm going to skip that. The one other indicator apart from equities, which I think deserves mention, is oil. Oil prices, Brent oil prices jumped 2%, and we're now almost at $81 per barrel. Remember, markets were opening up after the Christmas holiday. So that is one. There was the US attack, US retaliation to the one-way drone attack, which put one US service member in critical condition. So there was that attack which happened on Monday, the retaliatory attack from the US, which happened on Monday. And the new thing, of course, not new, but over the last couple of days, there's a multinational naval task force, which is basically trying to bring the Red Sea, Suez Canal trade route back online after the disruption that we saw. So Maersk, for example, one of the largest shipping liners in the world, is now said, based on the support from this multinational naval task force, that they'll try to ply that route once again, the Red Sea route once again. By the way, some of the big listed shipping stocks in the US last night sold off. One large name was down almost 12% or so. But more on that later. We've got a discussion planned on this a little later in the day. But oil, I think, is the commodity that you want to focus on this morning. Now, just to look at the market here, we of course have been Teflon coated for some time, and very little has kind of impacted the up move that we've seen. Yesterday, as I said, 100 points. And with that 100-point move yesterday, the Nifty is now retraced 78.6% of the recent fall. We, by the way, did not close above it. We closed about 15-20 points short of that 78.6% level. Now, the all-time high of the Nifty, of course, is about 21,600, 21,593 to be precise. So there is that 78.6%, which is about 21,461. And then there is the 21,600 level, which is the all-time high, which should be in sights. If this momentum is to continue, and doesn't look like there's anything which perhaps will puncture it, at least not for the next couple of days. Support comes in at the 20-day moving average, which is also, by the way, moved up as compared to yesterday, which now stands at 20,913. Again, not very far away from where we are right now. For the Bank Nifty, on the way up, the high, which is 48,700, 48,701, is the level for the Nifty Bank to take out. And support for the Nifty Bank comes in at about 46,787. Which is the closest, at least on a moving average basis. Just two other points. The leader of this bull market has been public sector. The CPSE index was up 2% on Friday. It was the top gainer last week. I think it's been the last top gainer for the quarter, for the year. And yesterday there was no letting up. So the PSU space shines on. And in the one space and there is, of course, within that rotation, right? There is so much there. There are railway stocks, defense stocks, there are banks, there are, other entities there as well. So yesterday it was the turn of defense to come back and do well. Cochin Shipyard, Mazgaon, Garden Reach, BEL, etc., etc. So that's been a space which has done very well. Just a quick look at the Nifty, GIFT Nifty. The idea is to try and, I would say, even with a 75-point uptick, the idea is to wait and not jump in and chase the 75-point move higher and hope to sell another 75 points higher, the much better thing to do is to buy when the market actually gives you an opportunity on the downside, a dip, etc. We got that yesterday, right to the word go, and then, of course, the market picked up, never looked back. That's a much better way to trade, at least, rather than going in all in with a 75-point uptick. So I would wait at a slightly lower level to get in. But that is only trading advice. Otherwise, in terms of just the up move that we've seen, that is continued. So if you're invested, I mean, I think you're just happy looking at the portfolio doing very well. Rima.
Well, looking at Asian markets, the ones that are coming back gradually, so feel good, right? But others are coming back from their extended Christmas break. So Australia, Hong Kong's back, to the open. And we're seeing lots of green across those markets right now. Japan has been, of course, extending its gain. So Asia is a nice little green picture. And as Prashant mentions, no problems whatsoever on Wall Street. Just another point that it wasn't just a tech rally on Wall Street last night. It wasn't just the NASDAQ, but a lot of the other sectors. When most of the S&P 500 sectors are participating in the move, in the holiday rally. And that is something that the bulls are taking heart from as well. The US 10-year, I mean, for what it's worth, just to put the rate out there on the screen, 3.88, so it remains below the 4% handle. And the dollar has been very, very range-bound, still very much around those 5-month lows. Dollar index at around 101.6 thereabouts, 0.5.6 thereabouts, so no problems from the macro standpoint there with the lower inflation print that we got at the end of last week itself. Just to come back and talk about the rally here, the PSU space, as Prashant mentioned. Prashant, for the better part of our careers, right, we kept hearing the narrative that the government has no business being in business. And who would have thought 2023 is going to be that year where it's going to be all about the PSU? 77% gain on the Nifty CPSE index makes it the best performing index, by a stretch compared to all the sectoral indices out there. In December itself, it's been a scorching 13 to 14% sort of a rally, and it continues. Might see some more action on power stocks because the market's just trying to latch on to wherever there's an idea of fresh news flow. Yesterday, defense and shipbuilders were doing very well. On power, the peak demand in winter has been sustaining above the 200 gigawatts handle. It's still not been anywhere close to 240 gigawatts. That's what we had hit right at the end of summer. But nonetheless, when there's a lot of demand, considering cold is getting pretty severe in the north, maybe power is one space that people will focus on today. Just to talk about the other major sectors and the participation, it's not been bad at all. IT lagged yesterday because of the Infosys news. So I'd want to see if there's any sort of fresh buying that comes back to large cap IT today. So that's one space to look out for. And banks haven't been bad. They've participated quite well in December, at least. They've tried to play catch up. Nifty's up 6.5% this month. Banks are all right. So if, we start seeing some more gains on banks, and who knows. By the way, we're less than 150 points away from fresh all-time highs. Yep. The way this market's going, maybe it wants one last hurrah before 2023 wears out.
Just to add on to that point about CPSC, right? 77% gain year to date. In the last 3 years, it's up 195%. And names like BEL, we've been talking about the year-to-date gains, but just take stock of the kind of returns they've given in the last 3 years. BEL is up 375% in the last 3 years. And in the last 5 years, it's up 500%. So that's clearly been, the star. And especially since COVID, you've seen some phenomenal multi-bagger kind of returns in the CPSC index. But the other two indices which have done well, one is RailTel, which is in fact the top sectoral gainer. It beats the CPSC index with a 77% rally year to date. And you've got the auto index also, which is, coming out of a very long period of a lull, a slowdown. And the auto index is up close to about 43%. Again, it's going to be a lot about the IPOs, which, come back and get listed on Dalal Street. So let me start with Mufti Brands. That's Credo Brands Marketing. Good subscription, 51 times. Watch for this. Happy Forging saw very strong subscription, 82 times. RBZ Jewelers, small company, modest subscription, about 17 times. So these are the three listings that we'll be tracking very closely today. But let's get you some money market views then. On the rupee, Kunal Sudhani of Shinhan Bank says, the dollar index drops to its lowest level since July at 100.8, now acting as an important support. The US core PCE showed the smallest rise since April of 2021. Expectation of Fed easing have intensified, and the market is pricing in a 15% odd of a rate cut in January of 31st and fully pricing in one for the 20th of March meeting. The market has also fully priced in 6 cuts by the end of 2024. Kunal says for the USD INR, 83.05 against the dollar acts as a support, while 83.28 acts as a resistance.
Well, on bonds, we have Ajay Magnolia of JM Financial, who says that amid low volumes and absence of major players due to the holiday week, volatility has been low. Durable liquidity is major worry as of now. That is impacting money markets a bit. He expects the 10-year benchmark yield to be between 7.16% to 7.21% today.
Okay. We have lots of stock-specific action that we'll be tracking today, and we'll get to that in our special Top 10 segment in just a bit. We're looking at Kansai Nerolac Paints, India Glycols, SJVN, Power Grid Corp, CMAC, Amber Enterprises, Lakshmi Organic, Cupid, and ONGC on the back of positive news flow. Zydus Life is the only stock on the radar today that could perhaps open in the red, and we'll tell you why in just a bit.
Okay, we'll get to the stocks with our team in a bit from now. Ed Yardini, president at Yardini Research, is now joining us to take some questions. Ed, good to have you with us here. Good morning. Season's greetings from all of us here, and it's good to see you as always. Ed, the S&P is now, as we wrap up 2023, back at Jan 2022 levels. I mean, basically at a fresh high.
Correct.
That's the global benchmark in that sense. I mean, the largest equity index. What's your sense? I mean, if S&P were to break out into a new high, are we looking at much higher levels into 24? Because there's the technical aspect as well, and there is, yeah, go on.
Yeah, I'm optimistic. I think since October of last year, and again October of this year, investors have come to realize that the U.S. isn't going to go into a recession. And I don't think we're going to go into recession in 2024. I think earnings are going to continue to rebound from a very minor earnings recession we had last year. And I think that as a result of that, I could see the S&P 500 going up to 5,400 by the end of this coming year, 2024. And I think it can go to 6,000 by 2025. The economy has been very resilient. It's had what I call rolling recessions that have been self-correcting. Now we're seeing some rolling recoveries in places like housing and retailing. But overall, the consumer continues to spend. The job market remains very tight. There's plenty of job opportunities out there. So I think the economy continues to grow and the market's going to go to new highs.
Ed, morning. So no recession for the U.S. economy in 2024, and the S&P 500 can rally to levels of 5,400. That's a good 13-14% upside from current levels. What about crude? Any signs that crude may have bottomed out? The latest Red Sea disruptions have resulted in a rise in crude prices. With U.S. economy showing far more resilience, is there a possibility that crude prices could inch up from current levels? What's the outlook for 2024?
Well, I think one of the reasons that we've avoided a recession in the U.S. is that we didn't need a recession to bring inflation down, not in this country. China's had a very significant recession, particularly in its property market, and China remains very depressed. Everybody's been waiting, looking for a recession in the U.S. I think there is a recession right now in China that continues into 2024, and China's been exporting deflation to the rest of the world, which is why inflation is coming down so rapidly. So on the one hand, we have the U.S. economic outlook looking quite good. On the other hand, China, I think, remains depressed. So I don't worry too much about crude oil going up to 100, but could it go up to 95, 90? 90, 95, I should say. It could go in that range.
Mr. Yardini, season's greetings to you. Good morning. So, the scenario that you presented for the U.S. economy, where we're not expecting a recession, maybe just mild earnings cuts and a recovery. Now, does that factor in a lot of rate cuts from the Fed? Or will that be the scenario in any case, and therefore maybe the Fed doesn't cut too much? And then could that present any complexity for financial markets? Because financial markets are rallying, expecting these 3 rate cuts next year.
Well, I think there still is sort of a lingering expectations that the economy will finally weaken, that there are long and variable lags between the tight monetary policy we've had since March of last year, and that these lags are going to hit the economy in 2024. And so there is sort of a consensus view out there in the markets that we'll get at least 4 rate cuts by the Fed at 25 basis points each next year. I say 2 rate cuts. I don't think that there's any particular reason why the Fed has to be too aggressive in lowering interest rates. I think the economy is resilient. I think the Fed has tightened, but I think the Fed has also normalized. Interest rates are back to normal. They're back, kind of back to where they were before the great financial crisis through the great virus crisis, which was really the abnormal period.
Got it. Ed, we'll leave it there. Thank you very much for joining us. It's a pleasure having you with us here on CNBC TV18, and wishing you all the best for as we sort of look into 2024 as well. You know, we'll take a very quick commercial break here. We'll come back. Our list of stocks to watch out for. We're lined up with our research team. So that's coming up in just a bit from now.
CNBC TV18, embarking on a quarter century of excellence.
Welcome back. As promised, it's time to talk specific stocks and prep you up for all the likely moves and shakers of the day. And our team is standing by for exactly that. Guys, hi, good morning. Let me start with Mangalam, because there's an interesting news on Kansai Nerolac, not so much about business expansion, but how they're looking to monetize their real estate. And Mangalam, if I'm not mistaken, this is a plot very close to where we are, where our office is, right?
It's right across our office, Surabhi. So, you know, Kansai Nerolac, the board has approved the sale of land, their Lower Parel land to be specific, for about 726 crores to the Ranwal Group. Doesn't matter in their overall scheme of things. Their market cap is close to around 26,000 odd crores. You know, the cash and liquid assets that they have on their books is close to around 1,100 odd crores itself. Not so much, but importantly, it denotes a shift in their company's mindset, because earlier in March itself, they had sold their Thane land to the Hiranandani Group for about 671 crores. So in this year itself, they've sold land that they have worth nearly 1,300 crores. And in a competitive environment for the industry, remember in the fourth quarter, we will have Grasim coming in, a lot of investments made by all the other players as well. Additional cash always helps. And for Kansai Nerolac itself, you know, the key triggers that they have, they are increasing their capacity to a 316 crore capex. They have commenced their backward integrated plants as well. Lower raw material costs will obviously support their margins. And a large part of their revenues coming from the auto sector, and demand revival out there will work for them as well. So in an environment like this, where the company is looking to become a lot leaner, it should be a positive, and it also has valuation support. See Kansai Nerolac in the green today.
Thank you very much for that. Let's go across to Sonal now for India Glycol and Zydus Life. Sonal.
Well, India Glycols is in focus. There's a capacity expansion that has taken place at their Uttarakhand plant, or a distillery at Kashipur, where they have added capacity of 100 KLPD, which is kiloliters per day. And with this, the revised capacity of their grain-based distillery has come into 400 kiloliters per day at this particular facility, and it is fully commissioned as well. That means additional revenues coming in. For Zydus Life, a subsidiary of the company, has received income tax demand of around 284 crore rupees. This is for assessment year 2024. So that is something which we will track closely. But these two stocks on our radar today.
Okay, Sonal, thanks very much for that. More stocks with news flow. Vivek is standing by with that list. Vivek, morning.
Well, good morning. You know, the first stock on our radar is LJVN. The company subsidiary, that is LJVN Green Energy, has secured a 100 megawatt solar power project through e-reverse auction that was conducted by the Gujarat Discom. The project is to be completed via the build, own and operate basis. The bid, you know, that LJVN put in was close to 2.63 rupees a unit. So the tentative cost of the project works out to around 550 crore. Project will be done within 18 months of the signing of the PPA. So now the company's solar as well as wind portfolio stands at over 5,090 megawatt. Power Grid, you know, a lot of news flow in that particular name. Number one company has successfully commissioned the Tirunelveli and Tuticorin Wind Energy Zone 500 megawatt renewable energy project. Along with that, two acquisitions in terms of transmission lines for the company. Number one, the Vataman transmission line, the company gets it for a little over 18 crore. This is for evacuation of transmission power from the Kavda renewable energy project. The second one is the Koppal to Gadag to transmission line in Karnataka. Again, the company gets it for 18.4 crore, again a transmission line. Last stock on the radar, CMAC, you know, the company has entered into an MOU with HAL Offshore. So the company will be offering the charter hire services of offshore support vehicle. The charter rate works out around $8,750 a day. So the total contract value for CMAC works to around $9.59 million.
Okay, all right. Vivek, thanks very much. We'll put all of them on our list. Upasana is also watching out for some stocks this morning. Upasana, which ones are those?
Well, first up is Amber Enterprises, ILGIN Electronics, a material subsidiary of the company, along with Noise Brand, have incorporated a joint venture company named as Steltech Technologies Private Limited with a 50-50% of shareholding. The aim is to carry on the business of manufacturing, assembling and designing of wearables and other smart electronic products. Next up is Lakshmi Organic Industries. India Ratings and Research have revised the outlook to positive and assigned a IND negative with a positive outlook credit rating with a proposed term loan of 115 crores. Well, next up is Cupid. Columbia Petrochemical Private Limited and Aditya Halwasia have successfully completed 113 crore of the open offer to acquire up to 26% stake in the company at 325 per share. Well, only 367 shares were tendered by public shareholders against the open offer, which is almost around 34 lakhs.
All right. Thanks very much, Upasana, for that. Well, let's talk about oil prices, right? I mean, they've jumped about 2% to nearly about 81 now. Manisha is here to put the spotlight in that important commodity. Manisha, morning.
Morning, and thank you for that, Prashant. Well, yes, after almost 3.5% of jump in the previous week, we saw 2% of gains overnight markets, as well as there were some more attacks on Red Sea. But yes, major shipping firms have begun returning to the Red Sea as the kind of council the U.S. has created, and that seems to have weighed on to the markets right now. So we're off 81 right now, but there is constant support from the fact that the U.S. strategic petroleum will start to refill its reserves. The easing U.S. inflation numbers, the markets are still reacting to the PCE data that we saw from U.S., and hopes of rate cuts in 2024 are supportive factors. There also have been more reiterating statements from OPEC reaffirming the commitment to output policy, even as Angola has left the membership of OPEC. And then it is about light volumes and lesser participation as well as we head towards the year end. But having said that, the prices still are trading at a 2-week highs, with the expectation that we could be looking at the first quarter of 2024, a range anywhere between 78 on the lower side to almost 95 on the higher side.
Thank you very much for that. Here is a quick recap then of the top stocks. Stocks with positive news flow are Kansai Nerolac, India Glycol, SJVN, Power Grid, CMAC, Amber Enterprises, Lakshmi Organic, Cupid and ONGC. The only stock with a negative news flow today is Zydus Life on the back of the tax fund. Let's move on and talk about more stocks, this time with brokerage notes associated with them. Sudarshan joins in with that. Sudarshan.
Today in brokerages, I have 3 stocks on which coverage is initiated. First one is MK on Tejas Network. It initiates coverage with buy rating. Target is rupees 1,050 per share. It expects company to execute orders worth at least 29,200 crore over FY 24-28. It expects company to generate revenue and EBITDA above rupees 30,000 and 6,000 crore respectively. It sees revenue peaking in FY 25 and settling at 5x FY 24 levels. Next one is Equirus on Alchem Labs. It initiates coverage with long rating. Target is rupees 6,295 per share. It says company is set to embark on an unprecedented margin trajectory. It expects higher margin on NLEM price hikes and greater chronic market share. It says closure of the St. Louis facility would aid further, and a possible correction in PNG prices could aid gross margin. Next one is Equirus on Protean eGov. It initiates coverage with long rating. Target is rupees 1,500 per share. It says company is a play on digital India initiatives. Company earns 80% of its revenue on per transaction basis across services and has been generating free cash flows while being profitable. Also, it expects new business of ONDC, cloud and international expansion to drive growth ahead.
Okay, it's a season of initiating coverages, right? Actually, it'll be interesting to look at all the initiating coverage reports we've had in the last fortnight, maybe the last 1 month or so. Should be a pretty fairly long list.
Shows the depth of the market, right? Like everyone's hunting for new ground, new stocks. So stocks like Tejas, they're not new. Yeah. Protean eGov at least is a recent listing, right? But Tejas has now come back into the brokerage radar with these initiating coverages. So more and more ideas for the markets in 2024.
Yeah, no, and we'll kind of, we'll do that. We'll compile and tell you which are the new initiations and where they are, etc. It'll be an interesting exercise to do. We'll take a quick commercial break here. Up next, Deven Choksi of DR Choksi Finserv will join in for some fundamental stock check. So that's coming up, and stay with us.
Welcome back. Yesterday was a winning day for our markets. The benchmark indices closed up with gains of about 0.4%. Mid-caps rallied for the third consecutive day, up 0.6%. And now we're just flirting almost close to our all-time high levels. The Nifty all-time high level was 21,593. We're about 150 points away from that. And the GIFT Nifty is suggesting that we could cover some ground and get closer to our all-time high level this morning. So the opening level on the GIFT Nifty is a positive start with a gain of close to about 76 points. But one perhaps concern on the horizon is the crude price. Now today Brent crude prices are closer to $81 per barrel. Overnight there is a gain of about 1 to 2%, but this follows a 3% rally on crude prices last week. So let's get you the latest on crude prices and the shipping concerns in Red Sea. Several big shipping companies, including Maersk, have planned to resume operations at the Red Sea as soon as possible. This is despite ongoing attacks by the Houthi rebels. The latest being on an MSC vessel that was struck yesterday. CNBC's Morgan Brennan gets us the update.
Maersk says it plans to resume container shipping through the Red Sea and Gulf of Aden as soon as operationally possible, quote unquote, amid the deployment of the U.S.-led military program Operation Prosperity Guardian, which is now in effect. A number of companies had rerouted their vessels from the area in the wake of those attacks on commercial ships by the Houthi militants in Yemen. It's a dynamic that has made the critical Suez Canal unusable or too risky for many carriers. The Iran-backed Houthis started attacking merchant ships in response to the Israel-Hamas war. Maersk did note that if the security situation worsens again, it would divert traffic again from the region. Another container shipping peer, Hapag-Lloyd, reportedly saying it too will decide on Wednesday how it will proceed with its Red Sea routes after suspending shipments as well. Last week, we spoke with the CEO of Nordic American Tankers, which transports oil across the globe. It had one tanker in the Red Sea at the time. The company telling us today that vessel has now passed through and is in the Indian Ocean on its way to Singapore. Keep in mind, though, the threat is still very much active. Just today, the Houthis claiming a missile strike on a MSC Mediterranean shipping container ship. All crew reported safe, no injuries. And last Saturday, a U.S. Navy's destroyer intercepting more drones and ballistic missiles.
Well, that's a latest report in terms of what's happening there. Now, the attacks on cargo ships in the Red Sea have also increased shipment costs for traders in that route. According to Ajay Sahai at the Federation of Indian Exporters Association, the cost for a 20-feet container carrying basmati rice from India to Saudi Arabia has increased from $600 to $2,000, and to Europe, the price has risen from $2,000 to $4,000. Listen in.
The cost for the basmati rice per container of 20 feet, if it is going from here to Saudi Arabia, which is the major market, or the Iran, the increase has already been between $600. It has gone up to $2,000. For Europe, it has gone from $2,000 to around $4,000. And there will be further significant increase. I'm not sure because of this conflict, the overall freight may also take a hike. And that is something which is a very serious concern for the exporter. Global trade is also passing through a very difficult time. We have the geopolitical uncertainty. And probably this is going to be the last nail in coffin. And that's why we are hoping that very soon the situation should be normalized in the area.
That's been the big story over the last week or so. We will slip into a very short break. Up next, we'll talk more stocks. Deven Choksi of DR Choksi Finserv will join in for some fundamental stock analysis.
CNBC TV. CNBC TV18, embarking on a quarter century of excellence.
Welcome back. Let's invite Devin Choksi on the show to talk about some stocks which should be on your radar this morning. Devin, morning. One of the big winners of yesterday were J. Kumar Infra. The stock was locked in an upper circuit of about 20%. There was a CLSA, note where they've raised the target price on J. Kumar, and they're saying it's raining urban orders. The urban orders for J. Kumar Infra have doubled on a year-to-date basis. Is there more upside in the stock, considering it's already up 120% this year?
So good morning, Rima. Well, I think this is a story with most of the infrastructure companies. Be it starting with, I think, a big daddy like Larsen, or for that matter, I think any other mid-tier, small-tier infrastructure companies who are basically winning all the major projects, particularly companies like J. Kumar, winning major projects in the metros, where the construction work is in full swing on the infrastructure side. I think the order book position will continue to remain on a stronger side. And if I may be at the risk of sounding a little bit more optimistic, I would think that most of the companies would probably have visibility hereafter on the order book side of next 3 to 5 years at any given point of time. Given the size of business, I think that the governments are putting in the hands of most of the contractors, I think the kind of business will be on a higher side. However, I think execution would be the key. Most of these orders would be over a period of time, I think 2 to 3 to 5 years. And that is where probably I think one will have to be mindful about paying the price and the valuation. The fact remains that I think most of these orders would get over a period of time executed. And as a result of which, I think the growth cannot be seen, I think, accelerating on a quarter-over-quarter basis. Maybe I think it would be a gradual growth happening in the subsequent quarter. Safe to assume that I think companies like J. Kumar could possibly produce on a yearly growth average of around 20% for next 3 to 5 years.
Okay, so that's a positive view on J. Kumar Infra. Devin, hi, good morning. Season's greetings to you. Just want to get your thoughts in on the PSU space, which has been the market's sort of favorite, darling in 2023. Specifically looking at the oil and gas companies, government-owned companies. I mean, there's oil is something that's on the move. We've got 80 on Brent once again. Now, would you look at any sort of plays here, either upstream on an ONGC or an Oil India, or even downstream for that matter? I mean, downstream stocks, IOC, BPCL, HPCL, they've had a good December, a decent rally on most of these names. How do you view them?
Yes, should be. Good morning and season's greetings to you as well. Well, I believe that I think the overall environment is going to remain steady for most of the oil marketing companies, as well as for the exploration companies hereafter. The price range, I think, is likely to remain steady between the $75 to $90 to a barrel. And that is where probably I think most of the game is going to be played, as I see it. Whether one is getting immediate advantage out of this particular price regime, or whether I think one is going to get the steady price regime, one is not completely sure. Given the kind of election phase that we are entering into in the country, I believe that I think the oil companies, particularly the oil marketing companies, will be finding themselves on a no price revision kind of a trajectory for next 3 to 5 months. In such kind of a period, if at all I think the crude oil prices goes up, then possibly there will be a challenge. And if the government, I think, is basically bringing down the crude oil price and making it steady for next 3 to 5 months, then again I think it is unpredictable kind of a quarterly results as far as I think these companies are concerned. I'm not a very big fan of buying into the public sector undertakings, oil marketing companies, or even for that matter, exploration companies. I would rather stay with, I think, likes of Reliance, where the business predictability is much better. Exports, I think, is remaining, I think, as their mainstay on the refining side. And at the same time, the realization remains relatively more steadier compared to their peers in the PSUs. So we stay with, I think, the likes of Reliance vis-a-vis the public sector enterprises. Even though they appear relatively, I think, giving some better return at this point of time. But still, it is making sense to stay with a player who is basically providing the long-term visibility.
Devin, hi, morning. Just a couple of names. Satin Credit Care, ICRA has upgraded their long-term rating. I don't know if it's a microfinance company. I don't know if you have any thoughts. And then chemicals, where stocks are starting to show some strength, maybe just a tactical move, just a bounce. We don't know for sure yet. We've not heard anything definitive from any of the chemical companies to say that, they've turned the corner. So if you have any thoughts on what's happening there, any stock picks there. So Satin Credit Care and anything in chemicals. Go on.
Yeah, Prashant. Good morning. Well, I guess I think most of the microfinance companies, small finance banks are having relatively better time, and they are taking the market share out of, I think, the cooperative banks in the regional areas. That's where probably I think the business condition remains relatively more favorable. The cost of money is also, I think, relatively at ease, though the RBI's regulations are coming into play in between for NBFC companies. However, I believe that I think most of the companies are having relatively stable costs, and at the same time, I think better lending opportunities in the microfinance, small finance space. So one could possibly argue for, I think, staying with these companies from an investment perspective. And at the same time, sooner they grow bigger in the size, I think they become the target for some of the private sector, corporate sector banks to be part of them. So that is where one could possibly make money on a steady basis. As far as I think the chemical companies are concerned, I think largely the input cost, I think, is remaining relatively more comfortable at this point of time, which is assuring the margins for them in subsequent quarters, which was up till now in the last 12 months or 18 months. I think that was not the situation. These companies were, most of the specialty chemical companies were, I think, vulnerable to the high cost of crude oil, and as a result of which I think they were unable to pass on the cost. On the other side, the scenario on the demand side has actually been improving. And many of the companies, I think, which are basically into contract manufacturing space, they are relatively having, I think, better visibility on the order book size as well as on the execution side. So I think one could possibly argue that some of the specialty chemical companies would probably remain, I think, better off in the given period. Maybe mid-tier companies like Anupam Rasayan, Amir Organics, or even for that matter, Vishnu Chemical in South. These are some of the companies where probably I think we feel that there is an opportunity from investment perspective.
All right.
Very interesting. Vishnu Chemicals, so name we don't hear too often. We'll look that one up as well. Nevin, stay on. We have more questions for you. But for the time being, let's head across to Anuj and figure out what he's making of the day's setup. Anuj, good morning. So lots of green continues on global screens.
Absolutely, Surabhi. Good morning. There might be fog in Delhi, but absolutely clear skies in Mumbai and in market, of course. There's a chance of Nifty hitting new high today itself. Normally, Wednesday of the month, last Wednesday of month, is a trending Wednesday, and it goes with the trend. The trend is, of course, on the upside, and the market sector has been one step back and two step forward. The market's latching on to two global cues, bond yield and dollar index, and not on crude, because the belief is that this rise in crude prices might be temporary, and that's why it's sort of ignoring that. Bad news is being used to buy stocks. For example, yesterday Infosys and Wipro both ended at day's high after bad news. The only thing is that the FI volumes are now 1/3 of normal. So, you're being driven essentially by HNI and retail money right now. Coming to Nifty then, the next resistance, as I said, is 21,575 to 21,600, prevailing all-time high. If you cross that and sustain above that, then I think 21,800 and 22,000 open up on the Nifty pretty fast. And the Bank Nifty is the one which really needs to sort of contribute a bit more. Over there, the first resistance is 47,850 to 48,000, and then the prevailing all-time high of 48,200 to 48,300. Support here lies in at 47,600 to 47,700, and then the big support around the yesterday's lows of 47,400 to 47,500.
Okay, Anuj, thank you very much for that. So that and there's a nice way to put it. Fog in Delhi, but all clear. The windshield is absolutely clear when you look at markets per se. Well, Peter Maguire, I think, is now with us, Chief Executive Officer at Exim Australia. He's with us to talk to us about what he's making of the jump in oil prices, which are nearly $81. Peter, good to have you with us here. Is it going to be short-lived, temporary, the jump in oil?
Well, good morning, Prashant. I don't know whether it'll be short-lived. So we're just going to see how it plays out as far as the situation in the Red Sea, of course, with the Houthi rebels, and what the costs are going to be as far as transport and taking different routes into Europe and so on. So it's really going to be a very interesting couple of weeks how this all plays out. And if it was to escalate, then I think that you're going to see further upside, considerable for crude. Or if it dissipates, then the heat will come out of it. So we're just in that holding phase at the moment, I think.
Peter, hi, season's greetings. That's a lovely looking tree right behind you. It's we can feel the cheer all the way here in our news studios. So thank you for that. But just to expand on that point, because there are a lot of moving parts and you have this task force coming together to kind of secure the shipping lines there through the Suez. If we work with the assumption for a second that this gets reined in and we go back to just pure demand supply dynamics in the market, then what is the range that you would forecast, say, as we get into January?
I think you'd probably look at those low, take from a Brent situation, I think you'd strip $6 or $7 out of it, so to be under 75, and probably WTI high 60s to early 70s. I think that'd be the range. But if you put the geopolitics in there, then that changes the whole dynamic as far as it just changes the dynamic. It's nearly a war premium building in.
So just to repeat the number there, purely demand supply. What do you think the cap could be?
Well, I think you'd be looking at, as far as WTI, high 60s to early 70s, so it'll strip a few dollars out of where it is at the moment. And Brent, you'd probably be, that $72 to $75 range. So I think there's $5 or $6 built in at the moment.
When you say if the situation escalates, Peter, what would you mean? I mean, now there's a concerted effort to resolve the situation, right? I mean, Maersk is saying that we'll take that route once again. How would it go the other way?
Well, if it does go the other way, Prashant, and you know as well as I do the delicacy as far as transportation and what you're going to do as far as tankers going through that whole region and everything that travels through the Suez. So if that was to be a choke point, similar to what we've seen in years gone by with the Strait of Hormuz, then that changes the footprint as far as freight costs. All of that escalates from an inflation side, and naturally from a crude perspective, I think you could put on easily another $5 to $10 in the short run. So we've just got to see how it trades, and the traders will show that. We'll see that it'll be dynamic as far as open interest and what projections are going to be across hedge funds and naturally all traders, retail and commercials.
Well, I have to say, Peter, that everyone seems, at least on the equity side, when we speak with people, very sanguine, that almost convinced that this is short-lived and it'll come off. Yep. There's no reason for prices to keep going higher. So that's I find that interesting to note, right? But markets have a way to surprise us. They find a way.
Well, they're very much so, and this is what the delicacy of these markets are, and also contrarians that see that. And I'm not suggesting I'm a contrarian at this stage, but very much you've got to look at the big picture as far as, again, what Subay said as far as the moving parts. The moving parts there are so many dynamics playing out here, and price discovery is going to be, I think, the determinant how it all plays into one factor, and that is going to be the price. And, you've had a very strong move to the upside for equities. It's been a bumper year. It's been nothing short of outstanding. And if that momentum continues, then that's fantastic leading into 24. But the crude could be a little bit of a disruption as far as price, I would say.
Okay, well, we'll keep that in mind. It's our job to look at all the factors at play, positive or negative, and let's see which way oil swings. Thank you very much, Peter. And once again, wish you, a great holiday season, the rest of it, and a fantastic start to 2024 as well.
Thank you.
With that, thank you. With that, let's head back to the market. We'll start getting our pre-open rates in about next 10 odd minutes or so. So our technical experts are with us to take us through today's setup. Mitesh as well as Srikanth joining in. Gentlemen, good morning. Good to have you on as always. Mitesh, so the cues, whatever thin cues we are getting are still very, very positive. We are less than 150 points away from fresh highs. What would the strategy be on the index?
Morning, Subi. I have kind of maintained that we will possibly do a consolidation between 21,550 to about 21,000. And with today's gap up, we'll be very close to that upper end of the range. A breakout beyond that will certainly take us to new highs. But my initial feeling is that let's take some profits off in this gap up closer to 21,550 and see whether there's continuation post this gap up. In case we see the index try and get past 21,600, then I think, we'll get back into longs again. But the initial feeling is to take some profits, wait for an intraday dip to re-enter on the index. Stocks, of course, you can trade tactically and be in the trend. But for the Nifty, this is the level which I'm watching for. The Bank Nifty, I would look at 48,150 as the key level. If we start getting past that, we'll initiate longs.
Okay. Shrikant is also with us. Mitesh, morning. Shrikant, morning. Shrikant, what about you? Mitesh is saying, I mean, if you get this gap up, take some profits and re-enter at lower levels on pullbacks. What's your advice?
Good morning, Prashant. Good morning, Subhi. Yeah, I think the way the last time when the market was close to this 21,600 levels, and from there we saw huge amount of profit taking. I think this time also we need to be careful unless and until the market is not crossing this level. We are going to see consolidation sort of activity. But about 21,600, there are like fair chances of hitting 22,000. But yes, between these levels, 21,500 to 600, we should look for reducing long positions. Also, if we go through with the overall performance of the market, then we are seeing higher top, higher bottom sort of series, but Bank Nifty is still underperforming. And that's the reason we need to be a little bit more and more stock specific.
Okay, so let's do exactly that. Let's get down to stocks. Shrikant, hi, morning. What are your trades for the day?
Yeah, good morning. I think, see, all these metals and mining stocks are really doing well. And most of these stocks are crossing their all-time highs. In fact, they have spent a lot of time within specific range, and now they are sustaining above those levels. So the next level could be much larger for all these companies. In that space, particularly, we like NMDC, which is currently around 201, 202. There we are expecting stock to move towards 220, 225 in the near term. So NMDC is a buy at current levels with a stop loss at 194. And also we like Greaves Cotton, which is forming some cup with handle formation. And on Tuesday, there was a solid rally along with huge volumes. So Greaves Cotton also looks good around 144, 145. Here we are expecting stock to move towards 170, 175. And we can keep stop loss somewhere close to 134.
Mitesh, what about you? What are your picks?
I've got all buy calls, Prashant. The first one is a buy on Coromandel fertilizers. And fertilizers and chemicals is a space showing good action, good momentum on the upside. So Coromandel is a buy with a stop at 1249 for targets of around 1300. Divi's Lab has had some kind of a breakout yesterday on the price chart. So recommending a buy with a stop below 3800 for targets of 4000. A buy on IEX with a stop at 153, where I would look for a first target of 163. And also buy on Infosys, which is regularly finding support around this 1520 mark. So keep a stop just below that, look for a target of 1590.
Okay, all right, gentlemen, got that. So those are the calls. We'll, of course, come back to you a little closer to the opening and get some more ideas in. It's about 9 minutes to go before we start getting our pre-open rates. We still have Deven with us, so let's see if we can toss some more questions to him. Deven, hi. I just want to go back to yesterday's big decliners, and one was Infosys because of this deal cancellation. The second was Bajaj Finance. The question's more on Bajaj Finance, actually, because that stock struggled for the better part of 2023. Now you have this credit card issue with RBL Bank, which is why yesterday we had the sell-off. But what would the approach be? I mean, multiple issues, I mean, NBFC regulations, etc. Would you be a buyer? Would you wait and let things settle down? What's your call?
Well, I think in case of Bajaj Finance, the core lending business is continuing to grow at the rate of 30% and above. And that is giving me more assurance that all the aspects of the business are in place. The company is, doing very well as far as the business lending business is concerned. As far as distribution business is concerned of financial products or the bank products for that matter, there may be in between some amount of challenges which probably one is experiencing, but that does not take away the larger part of the picture as far as the company is concerned. In fact, any correction in the stock price of a sizable amount possibly would mean that there will be a buying interest at the lower levels. Largely because of the fact that currently the price to book value at which the stock is quoting is possibly leaving, I think, very little headroom for somebody to enter into the stock and make money. Unless I think one sees around 15 to 20% kind of a headroom in the stock, I think one is not going to buy this stock immediately. And that's where probably you are seeing the sideways to downward movements in this particular counter. I believe that any corrective downside in the stock price would make the case for investment in this company. Fundamentals remaining absolutely very strong and convincing. And I think that's where probably I think one would like to keep an eye on. Maybe I think such kind of stocks there probably the market has already priced them in a given situation. One will definitely have to wait for the price to lower down before getting into it because other fundamental aspects remain strong and convincing.
Devin, you want to, as we look at it to 24, any stock ideas, picks from your side?
Prashant, I think generally believing that the consumption theme will continue and it will accelerate. On the industrial consumption side, largely the infrastructure and the industry's expansion would mean that the ancillary businesses within that I think would possibly continue to have a larger amount of business in the order book. One among them could be the railways, second would be the defense. I think that theme will continue. However, some of the companies which are expensive, I think they may probably find themselves on the sidelines. We will have to look around for newer ideas, newer listing of the newer companies in the same period. Similarly, I think auto ancillary looks, I think, pretty interesting along with the auto OEMs. The likes of Tata Motors and within that the ancillary units who are catering to the companies like Tata Motors, Ashok Leyland, they would remain probably, I think, one of the better of the lot in the entire theme. Within the IT space, we believe that engineering and R&D space gives reasonably high amount of visibility, though some of the companies are expensively quoted. Maybe corrective downside in stocks, I think, would mean that there is an opportunity to buy into this company. So selectively, one will have to play the theme in 24 in coming year.
Okay, all right, Devin, we'll leave it there. Thank you very much for joining us and running us through all of those. So lots of themes, but I mean, as we've heard from many, a lot more selective, and it's not themes generally have done very well. So within themes now, the market is doing exactly that, trying to pick where price performance has not been great, or there's some amount of relative underperformance, etc., and trying to correct that. We'll take a quick commercial break here. We'll come back. I think the pre-open should be with us. We'll also have Prabal Sen of ICICI Securities to put the focus on OMCs in particular. Oil marketing companies continue to do very well, especially names like HPCL, etc. Stay with us. That's coming up.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Well, the cheer is real in the pre-open. If you go by the pre-open rates, we're getting a fresh all-time high today. 21,605 is where the Nifty in the pre-open is. That's a full 160 points higher. Let's see if it plays out as strong in the actual opening or not. I'm just checking, looking at stocks that are moving higher, and again, very, very early on, but pre-open is suggesting that IT will have a good day today. And we'll see if that plays out. Infosys, Wipro, TCS, all these stocks are up and about, as are the banks, SBI, ICICI. Early indication that banks and IT will perform, and if the duo perform together, then we know we are getting an all-time high today. So let's see. Lots of green. That's the indication, at least as of now. Speaking of all things green, well, the IPO party continues, and we have more listings coming in today. A couple of interesting companies. One of them is a forging company. The other one is a men's apparel company. We have Upasana joining in to tell us about both of them. Upasana, fill us in.
Well, two important IPOs, Happy Forging and Credo Brand Marketing, getting listed today. In terms of Happy Forging, the IPO subscribed almost 82.04 times, and the issue size is around 1,000 crores for the IPO, with a fresh issue of almost 400 crores. In terms of price band, it ranges from 808 to 850 rupees per share, and the company has raised almost 300 crores via Anchor Book. Now, let us understand about the company. The company is the fourth largest engineering-led manufacturer of forging products in India with a 40-year experience, and it has the second largest production capacity for commercial vehicles. In terms of annual installed capacity for forgings, it is around 1.2 lakh metric tons. The company also enjoys a strong financials with a revenue CAGR of almost 43% from FY21 to FY23. EBITDA margins in FY23 stand at 28.5%, and company enjoys a ROA of almost 21.1%. Now, next up is Credo Brands Marketing. The IPO subscribed 51.04 times, and it has an issue size of almost 550 crores and a price band of almost 266 to 280 rupees per share. Post issue, the implied market share will be around 1,800 crores, and the company has raised almost 165 crores via Anchor Book. Now, let us understand about the company. The company was incorporated on 29th of April 1999, and the products are classified into mainly three categories, that is topwear, bottomwear and outerwear, and the products are across various price range. The company believes that the menswear organized market share will grow at a faster pace as per industry reports. And in terms of total touch points of the company, it stands at around 1,807, and the company has already opened 31 new stores this year. In terms of financials, the Q1 revenue stands at 118 crores.
Okay, by the way, there's some news flashing on the screen with Wipro. Jatin Dalal was the CFO of Wipro. He's in fact been a Wipro loyalist, a veteran. He was with Wipro for 21 years. He assumed the role of the CFO in 2015. So for about 8 years, he was, the CFO of the company. And he announced his decision to step down sometime in the middle of the year. His last date was 30th of November. And in a very unusual development, Wipro has now sued Jatin Dalal. Jatin Dalal has joined a competitor. He's joined Cognizant sometime in December, and Wipro has gone ahead and sued Jatin Dalal. This is in the Bangalore court, and the matter now appears to be, it might move on to arbitration, where the two parties will sit across the table and, discuss, how to proceed with this. Very often in, IT companies and in fact in the corporate world, you have senior employees joining competitors, but you don't often hear of legal cases being, filed against them, and particularly because Jatin Dalal has been such a Wipro loyalist. He's been with the company for 21 years. So this development, according to analysts, is a bit unusual. So that's, the Wipro Jatin Dalal case. The matter will be heard now on 3rd of January 2024, where the two parties perhaps will, go in for arbitration. But let's turn our attention now to crude oil prices. Oil and gas crude prices have surged overnight. Oil marketing companies have been buzzing lately. Probal Sen, the energy analyst at ICICI Securities, now joins in with his call on the oil and gas space. Probal, first, an open-ended question. What is the outlook for 2024? The top three themes that will dominate the oil and gas sector next year, according to you, and how will this then impact the stocks?
Well, obviously, crude prices, as you mentioned, is always the number one monitorable that remains of interest. At this point of time, I think what is of interest is that crude remains in a fairly sweet spot as long as it remains in the range of around $75 to $85 per barrel. I think OMCs as well as upstream continue to remain in a comfortable space. The reason I say that is if you look at the last period when prices were actually held up for retail fuels, crude prices at that time and implied product prices were in the range of 90 plus. So any price about $5 to $6 less than that continues to allow leeway to make healthy marketing margins. Even if you were to assume that there could be a price decrease that could happen in gasoline and diesel prices, there is enough of leeway for the OMCs to continue to make reasonably healthy marketing earnings. Alongside that, our call very clearly is that if you look at the refining space, if you look at the overall crude space, there is a bit more tightness that we expect to come in the next 12 to 18 months than what is, sort of reflected in the prices right now. Our sense is that demand growth for crude continues to be underestimated fairly consistently over the last decade by most forecasting agencies. And invariably what happens is that once you start to play catch up and demand growth starts to exceed estimates, there could be a little bit of tightness in prices coming in maybe over the latter half of next year. And that's something, of course, that will depend on how the supply shapes up, specifically from OPEC, where there is increasing concern that, the supply cuts may not actually come about to the extent that they have been declared, because compliance will become an issue for some of the smaller OPEC nations. Having said that, overall, our sense is crude will probably be in the range of around $80 to about $90 with the bias probably on the upside at this point of time. So to that extent, for upstream specifically, I think that is a fairly good range, because even with windfall taxes being there, net realizations have consistently remained at $75 to $77, and that is still much higher than their last 8 to 9 year averages. So as I said, crude prices and GRMs probably would be two key monitorables. As far as gas is concerned, I think even in this year, what we have really seen is that with winter probably being slightly normalish, the inventory buildup in Europe has been so strong that even without any Russian gas supply, even in this year, the spike in LNG prices has actually been far less than what you would have expected. Spot LNG prices, if you really look at it, spiked to about $17 to $18 in October. They've sort of been driven back down to about $15. So that again is fairly good news from gas consumption and margin standpoint, because what the slightly lower crude also does is that even term LNG prices, if you factor in the fact that they're at roughly about 13% linkage to crude, those have also sort of softened by about $1.5. And that is a fairly significant delta, particularly from the CGD standpoint and overall gas demand standpoint. Every dollar decrease in gas costs improves gross margins by anywhere between 1.5 to 2.5 rupees per SCM for the CGDs. And I think, if not passed on, of course, and, the lower gas cost also, should allow for slightly higher gas demand, which is good news for a player like GAIL, for example. So things from a macro standpoint actually look fairly healthy. Obviously, anything can, happen given that the Russia-Ukraine conflict remains uncertain. Now there are concerns that it is spreading towards the Red Sea and disrupting shipping freights. We don't know how much US production will grow, after the stunning growth that we have seen in this year. So there's lots of questions, but based on, the data that we have right now and from what we can see, I think the next 12 months should be fairly strong for the entire space.
Prabal, hi, season's greetings. And it's interesting that you mentioned that. So let's for a second leave out geopolitics, because, no one can predict what might happen tomorrow in the Suez. But given everything else that you said, from an investor standpoint, if I want to add, a couple of energy names to the portfolio for 2024, then what should I be looking at? City gas distribution, as you said, because there's probably a margin delta playing out there. Should I go with, Reliance for a second? If we just look at the oil and gas side of the, of the business over there, could Reliance be a big play? What should be the top must-haves in the energy complex in the portfolio in the next year?
So what we have been basically looking at, I think if I look at across, let's say starting with upstream, we would be definitely positive on both ONGC and Oil India for different reasons. As I said, realizations continue to be strong, and after a long period of delay, the KG Basin asset from ONGC does look like it's closer to commissioning now. Sometime in the in January, full-fledged startup should happen, and that will reverse the last 7-year trajectory of production decline. Oil India also is showing a healthy growth in production. They have put in place fairly aggressive targets for growing both oil and gas production over the next 3 to 4 years. So, and of course, they benefit from the fact that NRL, which is also doing an expansion of its refining capacity in a fairly reasonably strong GRM environment, that adds to the consolidated group earnings in a major way. So to that extent, I think Oil India also looks good. In downstream, HPCL, is probably one that I would look at. They are expanding their refining portfolio significantly. They're adding to their petrochemical capacity, which changes the margins mix quite significantly, as well as changing the scope and scale of the business. leverage continues to remain comfortable, and even if you build in fairly normalized marketing margins, my sense is that earnings for 25 and 26 will continue to see upgrades the way that FY24 earnings have seen upgrades across the street in the last 2 months. And valuations remain at less than 4 times 1 year forward earnings, which is, I think, a fairly reasonable level. Enter the story. As far as gas space is concerned, we would probably play GAIL and MGL as the two players. I think for GAIL, the rising gas demand, as I just mentioned, along with the softening of LNG prices, is probably a significant delta for earnings across segments. And MGL is one name that stands out in my mind in CGDs, because there is sustained margin strength, steady volume growth that is in prospect, and any improvement in gas costs, even from here, should add to the margin profile. So those are the 5-6 names. Reliance, yes, the OTC segment obviously should benefit if refining continues to stay strong.
Fair enough. So ONGC Oil, GAIL, MGL, and Reliance as well. HVCL, of course, in the oil marketing track. Prabal, thank you very much. Great speaking with you. Appreciate you joining in with that quick chat on the oil and gas space. Now, 9:10 calls with Mitesh. He's with us. Mitesh, what do you have?
Prashant, I'll go with a buy on DVs for target of around 4,000.
Okay, DVs with targets of around 4,000. Got it. Standout brokerage reports. What's on the list? Nimesh is here with just that. Nimesh, morning.
Hi, morning, Prashant. So today's standout is on cement sector. A big upgrade coming in from Nomura. They've raised the target prices as well as upgrade few of the stocks as well. So the upgrade includes the stocks like Ultratech Cement. They've upgraded to buy now from neutral. There they've raised the target price to 11,500. On Dalmia, they've raised the target price to 2,900 versus 2,600 earlier. And on Ramco Cements as well, they've upgraded the stock to buy from neutral. And there they've raised the target price to 1,250. They've maintained a buy on Shri Cement, and there they've raised the target price to 33,400 now versus the earlier target price of 27,800. Now, why Nomura is bullish on the cement sector? They believe that the momentum on pricing and volume is likely to continue. They expect margins to expand on strong volume growth, pricing discipline in the industry, as well as relatively lower fuel cost. They expect the sales growth momentum to continue in second half of FY24, and by FY25-26, the volume growth will be higher than what we saw in the last entire decade. Also, in terms of trade prices, that's likely to improve as the industry exits the pre-election phase. So, on back of strong volume growth as well as pricing discipline, they've raised the target price on all the cement stocks, and they've upgraded a few names, which includes Ultratech, Dalmia, as well as Ramco Cement.
Okay, thank you very much for that. Let's talk about Godrej Consumer Products Limited, GCPL. Mangalam joins in for more. Mangalam.
Well, the stock has been doing well, and this morning we have an update coming in from ICICI Securities. They've upgraded the stock to buy. They've raised the target price by about 20% as well, from about 1,050 to 1,260 odd rupees. Why is that? Because a conversation that they had with the company's CFO Asif Malbari suggested that the company has fast-growing categories which have double-digit volume growth potential itself, and they are driving their underlying volume growth by entering categories that need development initiatives itself. And not just that, it's visible in the way they've gained market share in the soaps business as well, and the integration of Park Avenue brands that they've acquired from Raymond itself. That's largely completed, so that should aid their business too. That's about the India part. Indonesia growth trajectory is also likely to improve, and their target out there is to improve volumes beyond the Indonesian GDP growth and see margins back to about 25% in Indonesia.
Has gone with that commentary on Godrej. Mangalam, thank you very much. We've got a 62-point gain to start things off. 21,500 is here on the index. Let's look at the leaders. Tata Motors is right on top, % higher. ONGC starts out positive. Actually, let me check out some of the other oil and gas names as well, the sector that we've just been discussing. BPCL, IOCL, for the time being, small gains on a couple of these oil marketing companies as well. Let's pull up Oil India. Yes, a gain of about 1% over there. So higher oil prices in general, spelling some early gains for some of the energy players. Then you've got the index heavyweights chipping in. SBI, Infosys, L&T. Quite a few of these names are on the upside as the day opens up. On the flip side, Wipro, a little bit of red, not too much, just about a rupee down. But this court case definitely hitting the headlines. Okay, now it's turned positive now. Very flat on Wipro. Actually, there are hardly any stocks declining. Hero Moto is down less than 0.5%. And that's about it. It's a very green-looking screen, and the Nifty is soaring now, 84 points higher, 21,526. LTI, Mindtree, Infosys. So in general, some rebound on the IT space. That's how it's looking like. So early start and looking very strong, guys. 90 points up straight away.
And now we're just about 65 points away from our all-time high level of 21,593. So getting closer to that. In terms of the big, mid-cap action, Kansai Nerolac, which has sold its land in Lower Parel to a real estate company, is up 6.5%. The value of the land or the sale price is 726 rupees. That's a stock which is gaining. Protean eGov. There was this initiating coverage by Equirus. Its recent listing, a play on India's digital infrastructure. The issue price was 792. The target price set by Equirus on Protean eGov is 1,500, and the stock is currently at 1,240. There is news, positive news on SJVN, India Glycol. Tejas Networks is another one where we've got an initiating coverage, and this time by MK. And that stock is moving up in trade. Zydus Life is one of the few stocks in the red today, and that's on the back of the tax demand which has been hit on the company. Castrol has retreated after the big move that we had yesterday. A couple of the other notable gainers include Vishnu Prakash. There is some news flow there, 8.5%, fresh 52-week high. And gains continue on PSUs, whether it's Nagarjuna Fertilizer, SJVN, GMDC, and South Indian Bank. A board meeting scheduled today where they will be considering some fundraising. That's got the stock excited.
75 points in the green is what we have. So it's a solid opening. This is in line with what the GIFT Nifty was indicating in the morning. So we got 21,500 back on the board on the Nifty. The all-time high, of course, which was made last Wednesday, 20th of December, was 21,593. So we're almost there, about 70, 80 points away. Now, just a few other names. Vishnu Prakash, right? It's a small company. We don't talk about it, at least not in the first hour. I don't recall mentioning it, but it's the second largest volume-led gainer in the market right now on the NSE. That almost 900 crore order from the Uttarakhand government. I think we mentioned that in the morning. Look at the volumes, 3 million shares on that name. So that's a big one. SAIL has come up as with a 2.5% gainer as the top volume-led gainer across the board. 116 on SAIL. I think we mentioned SJVN, which is up 3.5%. Neyveli Lignite, that is NLC India, saw a very large move. Actually, last, I think Thursday, stock was at $200. It's 260. So this is in 4 sessions, 3.5 sessions from 200 to 260 on NLC India. We, by the way, had the management right before that move started with us here. Ambuja Cements is up about 3%. Nimish was telling us about that Nomura call on cement stocks, and we'll revisit that a little later. GMDC is another one, which with a 3% gain, looking strong. Adani Energy Solutions is up about 2%. Adani Green, of course, with that news yesterday, went up 4.5% by close, yesterday. So these amine companies, Alkyl Amine, Balaji Amine, they were up 5-6% yesterday. And they're starting higher. Alkyl is up 2%. So watch out for Balaji as well as, we get into the next few minutes and hours. Amber is up about 3%. And South Indian Bank is another one, which is up about 4-5% as well. So, out of the gates, coming up with not bad volumes at all for this time of the year, last week of the year. So this is looking good. Vedanta is down about 3.5%. And it's selling off on some large volume. Second largest volume-led loser across the board. Stocks at about 252, 253 right now. And you've got PC Jewelers, which sold off 10%. It's down another 4% right now. And there is KPI Green, which is down about 5% as well at 1,265 at this stage. So that's the overall picture with the market open 80 points in the green. Atul Suri is now joining us. He's a market master of the day, CEO at Marathon Trends PMS. He's with us here in our studios. Atul, great to have you with us here.
Thanks.
Season's greetings, and I'm surprised you're not globe-trotting somewhere at some
Trekking
fancy
away or
destination.
holidaying
Yeah.
at a...
With us.
Too much traffic everywhere. I mean, whether it's the hills of Manali or it's Goa, or it's Bandra.
Even in the air, right?
There's too much traffic. I think this is a week it's best to be at home. In fact, I dread to even go around my house because over the weekend I had to just go to a friend's house in the same suburb.
Yeah.
And it took me 1.5 hours to get back home. So you can imagine.
Zoom, I think Zoom celebrations, that's what you have to do in the last
Lata
week.
was Lata's in Goa, and she was telling us yesterday at she was at the Goa airport. Absolute madness and chaos. Absolutely. With flights.
So you need a holiday after a holiday like this.
But, and maybe that explains the excitement in the market, because people like you, and I'm sure there are others, who have not chosen to stay away. The screen's been looking exceedingly good. And Atul, I remember all our conversations, Diwali and even before that, you made the point that this is looking like a strong trend and there's no reason to get away from that. And it's playing out absolutely as per that script. What next? 2024.
Yeah, I mean, so what next is the question. Every prediction you make on the market has 3 stages. The first is laughter, second is acceptance, and third is what next. So last year when I predicted a bull market in 21,500 or whatever, immediately the market fell 1,000 points. The whole Adani thing happened, 17.5 to 16.5. And everyone were laughing at me. So when a lot of people laugh at you, you feel very good because there's disbelief. Then it crossed 19,000 and then it was acceptance. And now the question is, what next?
If you don't accept it, there's a 4th stage. It's called grief.
So when people say, what next, you shouldn't give targets.
Okay, no targets, but let me make it qualitative. Let me sort of, in the sense of how do you approach it? And it's the same sectors that you've been speaking about, right? That whole capital goods space, PSU space. The same narrative continues. And therefore, it's causing maybe a sense of disbelief to an extent.
Yeah, so I think that the mindset of most people is that, things have gone up. So they are like skeptical, oh, it's already gone up too much. Now, when I look at global markets, etc., what I think is that the global bull run in equities is just starting. If you start seeing, especially I think, look at the US, etc., you'll find that these markets are just now pushing towards lifetime highs. And if you take a step back and you realize that what is the genesis of all these things that drives, as I said, this is the mothership, is where US 10-year bond yields are. We had almost pipped 5, and you'll find that today we are just below 4. So I feel that bond yields are heading lower to around 3.3, and this whole global narrative of inflation will cool off. So to say, what was the perfect Goldilocks scenario where inflation would cool off and growth wouldn't, get thrown into a recession basket. I do think that the year is going to be dominated by global markets. So when I see whether it's S&P or it's the Dow Jones Industrial or the NASDAQ, I see almost a 18 to 20% upside from here.
Wow, and that's after such a strong year already. Talk about...
So actually, Surbhi, they haven't had a very good year last year. I mean, for them, it's been a year of fall and recovery. So that's why I said the bull market is actually starting there. And I feel that that is going to be very, very positive because for India, obviously, we've been probably the first market to break out to lifetime highs. In fact, very few markets are still at lifetime highs, but India is the first to break out. So I think in a scenario where global markets, I feel, have a 18 to 20% upside, I don't think that India is going to lag in a big way. The question is, will we relatively underperform, outperform? Have we front-ended it? Have we already run up in I think these are questions that we will, I think, have to struggle with during the year. But I do think that we are heading into a year which is going to see a very good upside in global markets. And what's going to change in India is that last year was all domestic, which is your domestic flows, SIP flows. Already December is showing it. But I feel that this year, the coming year, will be the largest FII flows the country has ever seen. So what we are going to have is, of course, the domestic money, which is steady and through SIPs coming. And you will see a very large flow of FII money. I mean, they have sold at 17, 18, not that they did not like India. I mean, they also are smart guys, but it's the way they are structured, the bond yields, cost of capital, they have various permutation combinations. And as bond yields are going down, I won't be surprised if you see a tsunami of FII flows in India.
Atul's answer is reminding me of a Bollywood song. Abhi to party shuru hui hai.
No, I mean, absolutely. Actually, in the US, for example, Atul, if you take we talk about S&P and NASDAQ having done 30% this year, it's the 7 stocks. If you, with the AI stocks, the AI frenzy which started.
Yeah, the Super 7.
So, it's interestingly, if you look at the equal weighted index, it is actually the S&P or the NASDAQ, it is actually flat. It may have gone up a few percentage points now, 3-4%. It's not 30%, it's 3-4%.
That's right.
But the index is what it is. I mean, it's just that 7 stocks have an outsized impact.
I think that's very relevant. And for me, what I feel is the most interesting thing is that actually the opportunity that's happening. Like I am looking at something like the Russell 2000, which is the small cap index, which if you look at it is not near 52-week highs, but nearer to 52-week lows.
Yeah.
But the way if the front end of the market does it, I have a feeling that there's going to be a very big alpha that is going to be created in that space. And if you look at the US, I mean, just to take off from where you look, if you do an analysis that comes to sectors and themes, because beyond markets, that's the next question. The fact is that the S&P 500 is just about 1% or so from lifetime highs. The NASDAQ is a fair bit away, 7 to 8%. But the Dow Jones Industrial has made a lifetime high. And it is a good few percent higher than that. So what I'm seeing is that not only is a bull market that I feel will happen globally and especially in the US, but what I think is that industrials will lead it. So yes, the Super 7 are doing well, that's driving the S&P, etc. But I have a feeling that if you look beyond that, a lot of industrial stocks, a lot of the old economy stocks are actually also at lifetime highs. And I think that the year is going to belong to the old economy. It's going to, be dominated by the industrials rather than just the Fab 7.
From the virtual to the physical.
Absolutely. Yeah, and I guess, there are things, alteration is a reality of life here. In our markets, what has not done well for 10 years, very often.
Absolutely.
Look at PSUs. Yeah. I mean, every guy had sworn. It was like almost, it was a written charter that we will not buy PSUs because people have burned their fingers over 10, 20 years. And if you look at the last year and this year, it's been the most stellar pocket that there is. So very often markets have a way of alternating, and where everyone is consensus bullishness actually disappoints, and where under ownership is there, that is what does well. So I have a feeling that even the US, that sort of upside is going to be led by industrials. And for my bet would be in the Dow Jones Industrials or the Russell 2000 rather than the NASDAQ.
Let's talk about back home. Right? In India, also industrials, PSUs have done well. And the narrative was there is an improvement in fundamentals, plus there is value. Valuations are fairly reasonable. But now the question is, will the fundamentals keep improving to the extent of re-rating that we should have in a bull market? If the stocks have to double, triple from here on, you need to see a tangible, a material improvement in fundamentals.
Sure.
Can that take place? Can the fundamentals move in step with the valuation re-rating for a bull market?
See, honestly, that only time will tell in terms of execution. But if you look at two sectors, which I look at it, defense, if you see the kind of order flows, there's been a lot of talk of indigenous defense work, but generally the order flows are coming. Now, how execution happens is a work in progress, and that we'll get a sense over time. But if you see the size of opportunity and the kind of order flows that are happening, I think it's massive. Second area, which I find very fascinating, and we don't have a sector per se, is railways. If you see the kind of work that is happening in railways, I think it's phenomenal. And for that, you must actually travel intercity by train. And you'll realize that it's actually better than flying an aircraft. If you fly some of the Tejas or, the Vande Bharat trains, etc. So there's a qualitative shift that has happened in railways. So what we are seeing is that not only is the size of opportunity big, I think the execution is improving. And then obviously the valuations were very, very cheap. So I feel that that's been a phenomenal story. The only thing is that it teaches you never say never in this market, because what people thought they will never ever touch has actually been the best performer.
Yeah.
So, and I take your railway point entirely. It took me 7 hours to come from Delhi to Bombay.
Right.
About 7 to 8 hours. So
Right.
I think trains are probably going to be a better mode of transport.
Especially if you're doing shorter distance, like you're doing some place in Gujarat or in Maharashtra, with flying time, the amount of check-in time and the mess. And
Exactly.
I mean, like,
The waiting
and the experience.
Places like Surat, etc. case in point. Very convenient.
I think the experience itself is far superior to flying in a plane, actually.
Yeah, absolutely. Experience where you're holding the railway stocks or traveling in the train. I think the experience has improved.
Definitely.
But, so, Atul, I think the question for 24 is that if the same themes will continue, and 23 gave us these themes, PSUs, defense, industrials, I think people feel a sense of complacency, saying, oh God, I'm not looking at a new idea. Am I missing something? Should I be looking at EVs? Should I go back to FMCG because FMCG is underperformed this year? The human mind tends to constantly look to do more.
Absolutely.
Otherwise, you're feeling you're not doing enough to earn your money, right?
Absolutely.
So what do you say to that conundrum that I think many would be facing as we step into the new year?
See, I'm a trend follower. That's my style of investing. And as the line goes, the trend is your friend until the end when it bends. So the fact is that if the trend is playing out, the need to do something all the time, compulsive action. See, in a bull market like this, someday sector A will move, sometimes sector B will move. But at the end of the day, you can't be churning your portfolio every week or every month. The important thing is for you to realize that what are the larger themes and trends. And you will have some weeks of underperformance, some week of outperformance. But I have noticed that in the end of the journey, however long it is, no one knows the ending. But the important part is that if you've got sectors and themes which show leadership and you have conviction, it's best to hold on to it. The need for activity is something which is more your own limitations. But even sitting, I have seen that the biggest wealth creation, as they always say, is in sitting. So if you've got themes which you believe in, I believe industrials is the theme that is going to lead, I would sit through it patiently.
So sit back and enjoy the ride.
Absolutely. Atul, thank you so much for coming down to our studio.
Thanks for having me.
Great chat as always. Season's greetings and all the best to you.
Thank you very much. Thanks, guys.
Thank you very much. Well, we're going to talk about one theme now where I think there's been a fair bit of excitement. It's a sector which has not done very well if you take, say, the last 3-4 years, although I think the fortunes looked like they were starting to change a little bit for a bit. There was a flicker of hope. Life insurance is what I'm talking about. So much regulatory change which has been proposed. Some of it has happened. The latest, of course, is what the IRDAI, the regulator, is proposing in terms of surrender charges, which insurance companies are allowed to charge their policy holders. Now, this is a proposal. It's a consultation paper. Sources tell CNBC-TV18, and we put the story out yesterday, that in response to the consultation paper, insurers want IRDAI to extend the time by which they can submit the feedback on the proposals till the 31st of Jan. The earlier date was 3rd of January. Yash is here with the latest, but also a bit of context in terms of why this issue is important. And then we'll get into a discussion with some experts. Yash, take it away.
Well, Prashant, the last 2 weeks we've been discussing everything, right, in terms of how the higher surrender value proposed by the regulator will be calculated. And of course, the sum and substance is that this particular proposal is beneficial for policyholders since it gets them a higher surrender value when a policy is terminated on a voluntary basis. But it's negative for life insurance companies because they get to retain far less in terms of the surrender charges which they charge to these policyholders surrendering their policy. The difference is significant, and I'll just give you two numbers to help you understand what kind of significant difference does it make. Policyholders are expected to get 50% higher in terms of surrender value to what they receive now, and life insurance companies will get to retain just 1/3 of what they retain currently in terms of surrender charges. Now, since the last 2 weeks, there have been various developments on this one. There are concerns raised by life insurance companies. They've written to the IRDAI chairman to seek a meeting to express those concerns. But largely, the concerns are that this will lead to an asset liability mismatch because the pricing happens in a certain way. Also, they feel that this will bring a drop in the industry persistency levels. As far as some of the suggestions which life insurance companies want to put forth as far as the regulators concerned, life insurance companies are saying that they feel that higher surrender value should be given on short-term policies and not on long-term policies because short-term are closer to maturity by the time they surrender. Same is not the case with long-term. Also, they seek the threshold limit to be a percentage of the premium, charged to the policyholder and what they've received. IRDAI, according to our sources, is not in favor of giving them that threshold limit as the percentage of the premium paid. Rather, the regulator feels that it should be the expenses which the life insurance company has made on a particular policy, plus some bit of nominal charges. That is the threshold which IRDAI sees. The same is not the case with life insurance companies.
All right, Yash, thank you very much for that. Well, let's take this discussion forward. We have, an expert in the field on the subject of personal finance, actually, the author of a book which needs little by way of introduction. Let's Talk Money. Monica Allan is joining us now. Monica, good morning. Great to have you with us here. Thanks very much. We have Nilesh Sathe, who is the former member of IRDAI, also with us. Mr. Sathe, thank you very much for joining us from a vacation. Really thankful.
Thank you very much.
Thank you, sir. Monica, if I can start with you, I mean, how do you look at it? You heard Yash explain, we've been on top of the story, since this was first put out. Is this going to be disruptive? Is it going to get diluted as you see it? What's your sense? Great for consumers, of course, policyholders, of course, if it goes through as what the regulator is proposing.
Right. So I want to put it in context. How would you react if a fixed deposit, a 5-year fixed deposit, if you exited after 1 year, gave you nothing back? You've put 1 lakh in a fixed deposit and for 5 years, but you exit after a year and you get 0 back. And after 3 years, you get 1/3 back, right? So life insurance policies on the traditional side are akin to deposits with a life cover attached to it. I have not for decades been able to understand why investor gouging happens when policyholders surrender too early. So if a person puts in 1 lakh and doesn't pay the second premium, today she loses all her money. After 5 premiums, if she doesn't pay the 6th premium, she gets out of 5 lakh only 2.5 lakh back. Right? So this is what I call the product is constructed like a trap with very high first-year commissions. IRDA has now allowed insurance companies to fix their commission levels. Sometimes it can go as high as 100%. So the first year entire premium is going as commission, and then the commissions are dropping to 7.5% in subsequent years. So the agents hard sell this product. And then because the companies make profits out of surrender values, investors are almost nudged and encouraged to surrender their policies early. You must know that the persistency is 44% today on the 5th year persistency, which means more than half the policyholders, less than half the policyholders take home half their money after 5 years, right? So you're getting less than half your money for more than half of the people who hold the policy. So the product is built like a trap. I am not sure why IRDA is treating the industry with such kid gloves. It needs to write a regulation. It can't say, here, I'm opening the locker door and you can decide whether you want to stay or go. So allowing the industry to fix their own surrender values is very surprising to me, that the regulator, when it's trying to solve this problem of investor gouging, is allowing the industry to do that. So that's my short point, that, you know, IRDA, write a regulation. Why are you afraid of the industry? Are you an industry association or are you a regulator?
No, but they, to be fair, Monica, they are trying to correct it, aren't they? They're doing something about it now.
But they're saying, okay, here is a way ahead. You decide how much you want to give back. Now, which company, when you're booking profits on this horrible surrender value profits, remember, it's the blood, sweat, and tears of policyholders which are being booked as profits on early surrender. Which insurance company is going to be fair? I mean, you know, it's not an industry which has covered itself in glory on investor interest. So you are handing the baton to them.
Yeah, no, I get that, and absolutely points taken. Mr. Sathe is also with us, someone who's been on the policy-making side. Mr. Sathe, you heard Monica. What's your first thoughts, sir, on the subject?
The first is there is a difference between a bank fixed deposit or a mutual fund and insurance. In case of insurance, it's a group of people who get insured, and out of that, certain percentage of people do die in the first year or the first day of taking the policy as well. And for them, the amount of money that is to be paid back by the insurance companies is much more than the premium which is paid by them. Where from insurance companies will generate this money? They will take this money out of the lucky ones who are surviving over a period of time. So in the first year, this mortality premium, which is in case of traditional plans, which is being prescribed, actually that is certainly on the mortality amount which is going out of the premium that is paid by the surviving ones will have to be recovered by the insurance companies. This is not like a fixed deposit. This is a basic difference. This is one part. I'm not here to, only talk about the regulator or the policy or the insurance companies. Understanding the rationale between it. We have seen that insurance is a long-term product. It is not a 5-year fixed deposit. Even in case of mutual funds, we have seen that the SIPs lapse after 3 years, most of the SIPs. And insurance being a long-term product, it is necessary that policies should continue for a long term. And for that, this is one of the arresting measure that the policy should continue for a longer period of time. This is one part. As far as profitability is concerned, over a period of time, IRDA has been looking at how surrender values can be increased. They have done it. In the past, LIC only used to give 30% of the premiums paid other than the first year as surrender value on 3 years completion. It has been now increased substantially. As Monica also has said, it comes to 50% at the end of 5 years plus bonus, which she has not taken into account. 35% of bonus will also be added to it. Anyway, that apart, what I mean to say is, one, whether IRDA should look into it, I say yes. Policyholders must keep on getting higher amounts as IRDA should prescribe it. If at all IRDA finds that this is adding to the profits of the company, IRDA should restrict it. But in the process, insurance companies should not be made to incur losses. This is one part which again the regulator also has to see. So this is one more point which I wanted to bring about, that let us not keep comparing the products, whether it is fixed deposit or a mutual fund or insurance companies or all financial products, and whosoever wants to invest in that product should invest. Whether insurance should be looked as investment avenue, answer is no. Why is it that people are investing in non-profit or participating policies? They should not invest. This is something which we should promote. Insurance is a unique product which gives huge amount of money on death, which no other investment avenue gives. So it should be invested only for that purpose. So this is something which should be promoted, and I personally feel that the step of IRDA is indirectly in this direction, that why do you invest in with profit policies or with bonus policies when insurance should be taken only for the purpose of coverage of risk on life. And if this is understood, you are getting less surrender value, okay, fine, so don't invest. You have
Mr.
to look at
Sathe,
insurance only from insurance point of view. Do that, and that is something which everybody of us should keep promoting.
Absolutely, Mr. Sathe. We couldn't agree more with you. And I think a lot of the pure play financial, planners, educators, people like Monica, a lot of the experts we call on the channel as well. I mean, I've never met anybody who says, look at investments through insurance. Each one of our guests always says that, cover yourself with pure term insurance and look at investments separately. But then, that's a much bigger conversation for another day. The point is that maybe it's not intentional. The products are not designed to generate more profit, but perhaps, even there are unintended consequences. And what's happening, as Monica said, with the commission structure, if you have commissions so high in the first year, the mutual fund industry, for instance, moved to the trail commission model, right, where commissions are paid out for investors continuing to be in the product. Perhaps along with higher surrender value charges, is there a need to look at maybe the commission structure? I mean, how can we ensure that investors do manage to surrender the policies that they don't like anymore or don't find useful anymore, and get an adequate amount of money back?
Yeah, if you are asking this question to me, let me reply. One is, no 100% commission is paid by anybody on any product. The first year entire amount goes for commission is absolutely a myth. This is one part. The initial expenses are high. Stamp duty is to be paid. Whether bank fixed deposit pays stamp duty or whether mutual fund pays such a high stamp duty on insurance policy is at 20 paisa per 1,000 sum assured, which is atrocious. GST at 18% is atrocious. Of course, GST doesn't come in picture at this point of time, but this is something which we should talk about, leaving it apart. The mutual fund product gives you commission based on the NAV. NAV keeps on going up. But in case of insurance product, which is a ULIP product, it is a fixed amount of commission that is paid because it is based on premium, and the premium doesn't go up. So there is a variation. See, what I mean is every product is different. If all products are identical, then why is it that people will take different products? Every product has a different flair. So those who like it will buy it.
I think you make your point, strongly, Mr. Sathe. Let me give an opportunity to Monica to come in as well and respond to some of what you said. Monica, go on.
Look, when Mr. Sathe is saying that a person buys a policy and he dies next year, where is the money going to come from? Now, I'm really surprised, being member of member like IRDA, he's making such a basic error. The whole mortality premium is designed by actuaries for exactly that point. So there is two parts of the insurance premium. There's a mortality part and there's an investment part. The investment part is 90% of the entire premium. The mortality part is less than 10%. And that mortality part is aimed to take care of deaths midway through the policy. So I just don't understand this argument that, oh, the people have to be paid, therefore there have to be high surrender values. You know, that's insurance 101, and I'm very surprised to hear that. Second is that here you when you're comparing a product, you have to see its function and not its form. What is the function of a traditional insurance policy? What are the products they buy? They buy basically government bonds. So what does an insurance policy do? It buys an 8% government bond and it gives the investor 2 to 3%. So this is one, in its essence, it's value destruction. Two, you are penalizing a policyholder who has been hounded by an agent, who's been lied to by the banking relationship manager to buy this product, which they say is a very high return product. And if you realize your mistake any time after the first premium, you suffer huge losses. So my point remains that it's built like a trap. And just the fact that the insurance companies listed on the market are suffering losses just on a draft which is consultative, which points in the direction of investors getting a fairer deal. If insurance companies' stock prices are falling, I mean, what other evidence do you need that these profits are built on the tears of policyholders who have just had their money gouged out? You know, I feel very passionately about this because not many people understand the technicals of insurance. When you understand it, you are aghast at the open robbing of policyholder that has been going on in the country for decades. So that's my short point, that this is an industry built on the blood and tears of policyholders, and it shows up in the profits of insurance companies, which are now suffering because IRDA has dared to put out a very mild draft. That's my short point.
We take this point, and I reckon this will require a slightly longer chat than the 15 minutes we've spent on the subject. But, we leave it here for now. Thank you very much, Monica, for passionately making your case. Mrs. Sathe, for strongly putting forward your point as well. We'll have both of you back and others as well to continue to debate and discuss this important issue in the insurance space. Thank you very much. And Mrs. Sathe, please do enjoy the remainder of your holidays. And thank you for joining us. Thank you. We'll take a very quick commercial break here. Markets up 100 points in the Nifty. We are back with the management of Max Estates. That's a pure play real estate sort of company out of NCR, Delhi NCR. And we'll talk about the business outlook. Stocks done very well. We're connecting with them in just a bit from now. And after that, we'll talk about the Red Sea Suez canal issue. And we'll have that discussion going with the Container Shipping Lines Association's Sunil Vaswani, who will be with us. Stay with us.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. We've got the market on a bit of a tear, roaring away, and the gain is almost a full 100 points on the Nifty, 109 actually, and the clock is still ticking, 21,550. Very, very strong opening that we have for us. Let's quickly move on and talk about the next company which is on our radar, and we're looking at Max Estates now. The stock listed on the 30th of October this year. Since then, it has moved higher by about 16%. The company launched its first residential project in Noida. Its pre-launch sales clocked about 1,800 crore rupees. Rishi Raj, Chief Operating Officer at Max Estates, is with us to talk about the plans going ahead, business outlook. Rishi, thanks for joining in. Season's greetings to you. Hope it's not too cold out there in Delhi NCR. But, let's start with the basics.
Nice to be here.
Lovely. Well, let's start with the basics. Tell us more about this first project, the Noida project. I mean, how the take-up has been like, and give us a bit of a near-term outlook. Do you, let's say, if we look at 24, 25, 26, do you plan to primarily remain an NCR, a North India sort of a company? Give us the way you think your mix will shape up over the next 2 to 3 years.
Thank you, Sonia. Thank you. As far as our first project, residential project in Delhi NCR is concerned, in Noida, this is on 10 acres, 1.1 million square foot, one of the least dense project in Delhi NCR, 201 units, and market has responded extremely well. They have responded extremely well to our promise of live well. The design is really focused on ensuring holistic well-being and top-notch consumer experience. So this particular project is not only sold, our first collection is in, and the construction is already begun and is well on track. So that's about our Noida project. In terms of our outlook and what is in pipeline, as you may know, we have successfully built a portfolio of 8 million square foot, of which 4 to 4.5 is commercial real estate, 3.5 is residential. Of commercial, 1.5 to 2 million is already delivered, and we have established a very successful track record in commercial office space anchored on work well philosophy. First 2 project, 100% leased. The third project, which got completed in Feb, already 50% leased at 25 to 30% premium. On residential, we are looking forward to launch our second project in Gurgaon mid of next year. This is going to be 2.4 million, right at the start of Dwarka Expressway in Sector 36A. And this is going to be first intergenerational project at scale that Delhi NCR would have seen. So that's what we have in portfolio at this point in time. In terms of beyond 8 million, we are looking forward to acquire almost 1.5 to 2 million square foot of residential opportunities every year to deliver on our guidance of 15% on an average growth in booking value year on year, which, as you rightly said, this year was 1,800 crore on the residential side. We are looking forward to 22 to 2,400 crores next year and take that trajectory of booking value to 4,500 crores. And that is the trajectory we would like to maintain.
Okay. Rishi, hi, good morning. Rishi, hi, good morning. Prashant here. Sorry, allow me to come in. So basically, pre-sales of 1,800 crores so far, right, on the residential side. And you're saying that for FY25, that number should be what? Should be 4,000 crores?
No, for FY25, the booking value
FY25, yes. Yeah.
Targeting is 22 to 2,400 crores, and then maintain a growth trajectory of 15% on an average. And seeing in a 5-year time, look at the booking value of 4,000 to 4,500 crores in terms of residential booking value.
Okay.
Yeah, and what about the commercial assets there?
Just one more thing, Rishi. You said you plan to add how much? 1.5 million to 2 million square feet annually. Is that the number? in residential?
So for us to deliver on this trajectory for residential booking value, we aspire to add 1.5 to 2 million square foot of gross development value through joint development or outright acquisitions in Delhi NCR every year.
Will you have to take on a lot? I mean, how will you fund this annually? Could you run us through your sort of on the debt side? What will numbers look like as you do this?
See, I think broad guidance in terms of funding, it will come through multiple sources. As I said, 8 million square foot is already in. Of that, 4.5 million is commercial. Commercial has got top line annuity potential of 450 crore at peak occupancy. So the sources of funding will be multiple. On the commercial side, we have got New York Life as a joint venture partner. On the and we will be using the LRD against those rental income as one of the sources. The internal accruals from existing residential project would be another source that would be used for funding. And we would also be looking for a joint, and we will be using joint development routes, preferably in the residential growth, to keep it from a capital perspective relatively asset light.
Okay, Rishi, before I go back to the numbers on the Noida project, just to get the debt picture out of the way. So what is the debt equity? I mean, the debt that you are comfortable taking on as you fund a lot of this expansion?
So if you look at our current debt to equity, it's net debt to equity today as of first half 2020 FY24 is 0.4. In terms of our guidance for debt to equity, we would like to maintain it below 1 on an average 0.7 to 0.8 debt to equity ratio. And as a matter of principle, we would not like to acquire land through debt. That will mostly be equity funded, and construction finance as and when needed will be through debt.
Okay, got that. Now I'm going back to the bigger number of 4,500 crores. That's the residential booking value number that you've given. That should play out from the Noida project by what, say, FY26?
No, so see, Noida, okay, let's distinguish between accounting top line and booking value. If you're talking about revenue, which in real estate get accounted for on possession, then the Noida project, which we have already booked 1,800, which will be collected over 4 years. Once in next 4 year Noida project is delivered to customer, it will be accounted as revenue in the top line in 4 years from now. What I'm talking about is every year, when I say booking value, what I mean is what is the value that we are expected to book through residential launches every year.
Yeah, got that.
Okay, beyond.
Let me just ask you about commercial on the two things, the Max Square Phase 1 and Max House. What is the progress in terms of sale, lease, etc.? Where are you at?
Okay, so just to recap for your audience, Prashant, Max Towers and Max House Phase 1 was our first 2 commercial office project in Delhi NCR. Both of them is 100% leased, 30% premium. Max House Phase 2, which is 1.5 lakh square foot, that we have got occupancy certificate in December, and I'm really happy to share that we already pre-leased before occupancy 54% of the total, and we expect it to lease completely over next 6 to 12 months. And that is again going to be at significant premium to micro market. As far as Max Square is concerned, which we got completion in February of 2023, which we delivered in a record time of 3 years from February 20 to February 2023. That since completion, we have already leased 50%, and we have a very solid pipeline and looking forward to completely lease that over next 12 months or so. And again, we are able to command premium in the similar range even for Max Square Phase 1.
Got it. Rishi, we'll leave it there. It's a pleasure having you with us here on CNBC-TV18. Thank you very much for your time. Season's greetings from all of us here, and all the best of luck as we head into 2024. Thank you very much. That's Max Estates. There are new listings on your screen as well. There is Happy Forgings and Credo Brands. So Credo Brands lists at a slight discount, 1.5% lower. Happy Forgings, though, is up 15%, so that's a big pop right at the word go on day one. 974 on Happy Forgings, and Credo Brands now at about 278. So, it's a... I can see some familiar faces with bankers, etc. there. And of course, you'll hear from both the managements on the channel a little later during the day, talking about the business. And I think now post-listing, they'll be able to share some financial guidance, etc. as well. So, a spate of listings. I think we had 3 yesterday, we've 2 today, and I think it goes on. So, very, very strong IPO market, primary market. Very well received IPOs as well, mostly doing very well.
So tomorrow we've got Azad Engineering, and then on Friday we've got Innova CapTab, which will be listing. So 2 more on the anvil this week. Now Credo Brands is back in the green. It opened lower, it opened with a cut, but now has managed to, it opened flat, it dipped a bit, but now is back in the green, while Happy Forging continues to have a fairly decent listing. Let's get to Mitesh once again. It's 10 o'clock, so it's time to revisit the market technicals and get in a few calls too. Mitesh, 100 points plus now on the Nifty, 4th consecutive day of gains now for the benchmark indices, and it's green across the board. It's a uniform day of green across the indices. What have you made of the morning, and what would your calls be?
So the morning is quite good, as you were highlighting. It's green, and the Nifty is also now on the verge of getting past 21,550, which for me is an important pivot. I think once that happens, then I think we can look at targets of around 21,700, 750 to begin with, and good chance of 21,950, 22,000 being tested as well. So stay long, trade with positive bias. The stocks that I have on my recommendation list is L&T. It's making a fresh swing high, so buy here with a stop below 3,500. Look for a target of around 3,600 as the first level to watch. And the other one is Bharti Airtel, which I would recommend buying with a stop just below 997 for targets of 1,035.
Okay. All right, Mitesh, thank you very much for the trades. We'll come back to you a little later to see how things go along. Well, let's now put the spotlight on the recent attacks on ships passing through the Red Sea trade route, which has, of course, raised a lot of concern in the entire shipping fraternity. 2 India-linked merchant ships were caught in drone attacks yesterday. The Indian Navy has now deployed 3 warships in the Arabian Sea, looking at the situation. And obviously, this has raised plenty of concern among traders, exporters, importers. We have Sunil K. Vaswani, Executive Director at Container Shipping Lines Association of India, joining in for a quick chat. Mr. Vaswani, thank you for the call. So we do understand that there is a concerted effort underway. There's a coalition of major international countries as well to try and monitor, and more military presence now along the entire Red Sea route leading up to the Suez. How are Indian shipping lines looking at it? Is there any fresh requests being made by the government for greater monitoring? I mean, what exactly is the state of play?
Well, morning, and first of all, season's greetings to you and to our viewers. Let's hope that the new year brings in some good news for all of us.
Thank you.
It's indeed a matter of concern. So let me start off. As far as the container shipping lines are concerned, we during the COVID, we did all we could to help the supply chains. We put in additional capacities and started new services, and then we were all on absolutely even keel, everything working out well, and then suddenly this thing had to happen. So another challenge that's come up, it's certainly a matter of concern. But what's encouraging is that the US-led initiative, Operation Prosperity Guardian, and the Indian, the efforts by the Indian government as well to ensure maritime security are indeed encouraging. In the meantime, of course, we were forced because some of our own ships also were attacked. And the container shipping lines, some of them were forced to divert some of their services from Red Sea and Suez Canal to over the Cape of Good Hope. And obviously, this did increase the cost, increase the transit time by about 10 days, and increase the cost because obviously the cost of additional transit, that increases the charter hire per day, also the insurance cost. Then we had to put in additional capacities. For instance, if you have I'll just give a quick example. If you're operating a service between India and Europe, the round trip takes about 56 days for 8 ships. And if you're going, and that's if you're going taking the shortest route via the Suez. But if you're going over the Cape of Good Hope and adding another 10 days, then you need to put in one additional ship. So that additional capacity has to be introduced, which also increases the cost because additional ships are to be put in. And of course, when the demand goes up for ships, the charter hire goes up, and also the charter hire per day goes up because of the additional transit. So be that as it may, that's what it is. But because of the encouraging news that we've had lately, as far as maritime security is concerned and Operation Prosperity Guardian is concerned, one of our lines, Maersk line, for instance, has announced that they will revert to the original schedule of going over the Suez Canal.
Suez, that's right, that's right. So, can we get some tentative indication of charter rates? I mean, since this whole issue flared up, it's been about, I think, what, 2 weeks now. What is the increase in immediate spot rates, if any? If you could give us some sense of the market right now?
See, it's very difficult to say that because charter rates depend on the size of the ships. And each of the lines have different size of vessels. But I can tell you very roughly, on an average, I can tell you about $60,000 a day is a charter rate. But what could happen is all these costs could translate into additional costs for the lines, and then eventually, of course, additional costs for the exporters and importers as well. Right now, the shipping lines, although they are going over the Cape of Good Hope and incurring heavy costs, the additional cost to the end customer has not been that significant. I mean, some surcharges that we were forced to put in place to take care of some of the additional costs have been done, but the overall effect has not been very significant. But if this situation turns for the worse and we are forced to continue over the Cape of Good Hope, then cost increases could be quite significant.
Okay. So, Mr. Vaswani, what percentage of the cargo has been diverted now to the Cape of Good Hope? So, say earlier, in 100 units, what percentage has been held back, not able to proceed, has not managed to divert? Just give us a breakup.
Yeah. So, as far as India is concerned, we are more impacted by exports rather than by imports, for the simple reason that most of the imports of India come in from the Far East, as we all know. And some imports basically come in from the West, that is Europe and US. So I would say about as far as roughly about 70% of our imports are concerned, by and large, we are not that impacted. But the reverse holds, because these exports eventually take place to destinations in Europe and to the US. And for those sectors, of course, we've had to, many of the lines have had to divert over the Cape of Good Hope, and that's why the increased transit and the potential increase in the costs.
Mr. Vaswani, just to go back to the cost point, you said 60,000 USD is, the day rate. And these are tough to generalize, I get that. But to understand the issue, assuming if there is to be this diversion and ships are to be routed around the Cape, then ballpark and higher insurance costs, given the scenario right now, ballpark for an exporter, what is the increase in freight costs we're talking about? Is it 5%, 10%, 15%? I mean, just rough back of the envelope math so that investors understand, what is the increase in cost of doing business?
Sure. So again, as you very rightly said, this is going to be a very ballpark figure because right now, things are very hazy even for us. But I'm just saying, just in case the situation continues and it continues to get from bad to worse and we're forced to go through this route and, put in all the additional services that are required or the additional capacities, then we could possibly say, for instance, from Nhava Sheva and Mundra to Europe, for instance, the increase could go up by another 80% or so. Also, so the freight costs overall to the ultimate customer could be to that extent.
Oh, wow.
But again, as I said, there's a ballpark figure if the situation turns for the worse and if the situation lasts longer.
Well, let's hope we don't go there. And hopefully, of course, governments across the board, I think, are cognizant of the matter and taking steps to ensure that secure shipping lines are restored through the Suez. Thank you very much for joining in. And once again, season's greetings to you.
And if I can just add on one more line, as far as we shipping lines are concerned, the safety of the cargo of our customers is of primary importance, and the safety of life at sea of our sailors, our staff is very important, and eventually the assets. because that's how we are going to be able to help the trade. And we've done in the past everything that's possible to help the trade, even during COVID and post-COVID, and we shall continue to do so even now. Thank you.
Okay.
Okay. Thank you very much, Mr. Baswani, for joining in. Let's get to the stocks on the move. Earlier today, our standout brokerage report was on cement. Nimesh had spoken about it. Let's go back to him. Nimesh.
Hi. So the entire cement sector is buzzing in trade today on the back of a large upgrade from Nomura. Across cement names, they've upgraded a few stocks to buy from neutral, and they've raised their target prices as well. So on Ultratech, the new rating is buy from neutral, and there they've raised their target price to 11,500. They've also upgraded Ramco Cements to buy now, and there they have a target price of 1250. And on Dalmia Cement, the new target price is 2,900 versus 2,600 earlier. Even on Shri Cement, they maintain a buy rating, but there they've raised the target price now to 34,400 versus earlier target price of 27,800. Now, why Nomura is bullish on the cement sector? They believe that the upward momentum in terms of pricing and volume is likely to continue. They expect the margins to expand on back of strong volume growth, pricing discipline, as well as relatively lower fuel costs. So the momentum in terms of volume growth is likely to continue in the second half of FY24, and by FY25-26, they expect the volume growth to be higher than the last decade's volume. In terms of pricing as well, they expect the trade prices to improve as the industry exits the pre-election phase. So on back of strong volume growth as well as pricing discipline, they've raised the EPS estimates, target prices as well across all the cement names, and few stocks are now been upgraded to buy from neutral earlier.
All right, Nimesh, thanks very much. Ramco is the top gainer in that space with a 4% pop. Heidelberg is number 2 with a 3.5% gain, and then there is Ultratech, which is up about 3% as well. We'll take a quick commercial break here. Manisha will be here with what's happening in the commodity space. Stay tuned, that's coming up.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. Let's turn our attention now to the commodity markets. Manisha is here with us. Manisha, what are you tracking?
Well, I'm looking at the iron ore prices, and that clearly has been the best performer within the metal sector. We are looking at prices trading at an 18-month highs. It's been a good year. We started on the lower side, and we are perhaps trading at the highest level at 2023 at this point in time. We are holding around $140 a ton, and it's up by 25% in 2023 till time, with a couple of days more to go. Well, China accounts for 70% of global demand when it comes to iron ore, and while the property sector has not been doing so well, what has been doing well for China and for the rest of the world is strong demand coming in from sectors like shipping, machinery, auto, and even infrastructure. For the Indian markets as well, the steel demand has been on the higher side, and iron ore is the major ingredient into steel, and that has been supportive for this particular metal there. If you look at the global trade then, and that has been increasing on an year-on-year basis as well. 2022 was 1574 million tons. This year is estimated at 1646 million tons, and next year almost 1700 million tons. And it's a similar chart when you look at the Indian iron ore trade numbers as well. It has been growing to the tune of 8 to 10% onto that one as well. I want to come on to prices. An all-time high has been at $223 a ton, which was hit in July 2021. We started this year almost at around $100, and the lowest for 2023 has been at 99.5. So 100 more or less has held, and the high is at 145, and that's exactly what we are trading at right now. For the next year as well, the markets believe that you could be looking at demand picking up, especially from the property sector as well. So not too many bearish calls coming in for iron ore for the next year as well. The most bearish actually is from Fitch Ratings at $95 a ton, but 100 to 120 is the expectation of an average iron ore prices from ANZ, JP Morgan, Fitch, and BMI as well. All of them believe that the iron ore prices will consolidate in the next year too.
Thank you very much for that. Let's get into a break on that note. We'll come back and get to our special offering, the big winners of 2023. Today, we'll chat with the management of RailTel. The company's MD, Sanjay Kumar, will join in next.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. One of the big winners of 2023 is RailTel. The stock has gained 130% in 2023 so far. And for this year, FY24, the company has guided for a 20 to 25% revenue growth. Sanjay Kumar, the Chairman and Managing Director at RailTel Corporation of India, is with us on the show. Thank you very much for joining in, Mr. Kumar. This is Rima here. there is a lot of excitement about the potential revenues or the opportunities from the entire railway segment. You know, we've had so many comments from the minister saying that the government is planning to invest about 7 lakh crore in the upgradation or new lines for railways. There is, Kavach, which is the, the protection system that you use for railways, which will be deployed on new lines, even the existing ones. Can you tell us the opportunity for, RailTel and also the game plan from the government?
Yeah, so thank you very much, Rima, for inviting me. Certainly, investors are posing a lot of trust and they are looking at a lot of potential in our company. We are also equally optimistic. And as far as you asked about the railway spending, so as far as RailTel is concerned, there's a kitty of around 1 lakh crore, which is likely to be spent over the next 5 to 6 years in signaling and telecom sector in railways. And RailTel is, I've been telling earlier also, RailTel is eyeing around 15% of this kitty to be executed by us certainly through tenders. We are already making strategy. Apart from this, we are also working on some future technologies. In fact, technology which is already there, but we can have a use of the same technology like digital twin and cybersecurity kind of requirement in every part of the world now. So these are another two areas where RailTel is working to get opportunities in railways, not only railways, but outside as well.
Okay.
So this is what I see about railways as far as...
Got it, sir.
As you asked.
Mr. Kumar, good morning. Prashant here. So what's the current order book at? Because you're telling us that you are hoping to win about 15,000 crores worth of the 1 lakh crore order, which you think will be put out for bidding. Over what period, sir, this is?
This will be executed over next 5 to 6 years. This our estimate.
And this should be bid out by when? The tenders should be out by when for this 1 lakh crore?
Tenders will be spread over a period of maybe next 1 or 2 years.
Okay.
And maybe some tenders might come later because Kavach is a new technology and Railways is also working out to make this happen with LTE technology. Presently, the Kavach which has been rolled out is on an old technology which is VHF. So the Railways is also coming out with the tenders, but I believe it will take another 5 to 6 months, maybe another 3 months also possible. But we are ready. We are working out with partners, continuously touch with the industry to take on these tenders.
And 15,000 crores is your expectation, and this will all be competitive bidding. Why are the competitive bidding route?
Of course, this is competitive bidding. And we have actually started taking projects from railways through competitive biddings, and we are continuously getting, including signaling, which was hitherto not our area of experience. So now we have started taking works in signaling as well.
Okay, so a big opportunity there, 1 lakh crores in terms of just fresh bids and new orders that can come in. Sir, talk us through execution as well. It's been pretty decent for the company, and I think you're aiming at about 25% growth thereabouts for the year that's going to close out 24. But just, translating the big order wins into revenue growth, sustained, strong revenue growth, what are the kind of annual run rates that you can hope to build on in FY 25-26? Can we get faster, speedier execution of these large orders?
Yeah, certainly speed is very important when we get orders. And we have been able to execute the works, but there were delays also, I accept that. But I would say that wherever we find that there are plugs, there are gaps, we try to plug them. And we have focus actually on two things. One is delivery and the other is receivables. So from government, receivables is another factor which affects our performance. And we are onto these two. So basically we will focus on these two things, and I'm sure that our young team will be able to do it.
So just to get the numbers, you're saying the signaling opportunity is 1 lakh crore, of which you're hopeful to win 15%. This will happen over what time horizon, the tenders?
So tenders, as I told you, I expect them to happen over next 1 to 2 years.
1 to 2 years.
Because these will be floated by individual railways. Sure. And certainly progress of the current projects will also impact the specifications and other things.
So the other opportunity is the Kavach opportunity. What is the size of the tenders over the next 12 to 24 months, and what is the market share that you're trying to garner, or you hope to garner?
See, if we talk of Kavach per se, if we take LT part along with the Kavach, so it is around 30,000 crore total opportunity size. If we talk of next maybe 2 years, yeah. So but the execution again will take time because there's a lot of infrastructure needs to be created for implementation. So that's why I'm saying that next 5 to 6 years is going to be the time frame when these projects will get executed and revenues will flow. So these are inherently not that fast projects as someone may think of.
Okay, and this 30,000 crores is part of that 1 lakh crore that you mentioned, right? Telecom and signaling, what you said. Yeah.
So just very quickly, finally, on the execution piece, revenue run rate, next 1 to 2 financial years, should we expect 25% revenue growth? Can it be 30%? And you mentioned receivables from the government. What is the receivable figure as of now, and by how much do you think you can reduce that as you focus on receivables in a big way?
We say, see, government projects, there are milestone payments. So if we talk of milestone payments, we are around 600 to 650 crores as on date. And generally, we are getting payments in time. So this is what I would say about the receivables. But yeah, receivables, even 100 crore receivables delayed by 1 month, we lose on interest, we lose on cash flows. So that's why we are focusing on that part also. And when we are doing more projects, this becomes even more critical factor.
And top line growth, can you improve better than 25%?
Certainly. Okay. There's no doubt about that.
All right, so we'll leave it on that note. Thank you very much, and season's greetings. Wish you a happy new year in advance. With that, we're completely out of time on this edition of Bazaar. Many thanks for watching. Chartbusters takes the action forward.